all you can really do is look how you're executing that plan. That's the only real true measure of your trading.
Two traders, Darren and Walter, pull back the curtain on profitable trading systems, consistent money management, and profitable psychological triggers. Welcome to the Two Traders Podcast.
Welcome to the Two Traders Podcast. Walter here, and I've got Darren on the line. Hello, Darren.
Good afternoon, Walter.
Yeah, so Darren, we were looking at this email that's come through from listener Chris, and I'll just read it for everyone because there's a lot to unpack here. There's a lot going on, and I think Chris brings up several really good points in regards to trading, and we thought that it would make a good episode. So here's what Chris says. Hi, my name's Chris. I love the Two Traders Podcast. I actually find it quite relaxing. And just so other listeners know, the reason why Chris's question made the cut was because of this first line. That one. Just kidding. All right. So I was wondering if you would be able to do an episode around the idea of dud trades, as this is something that I've been thinking about lately. What I mean by this is no matter how stringent the process or how many checks you put in place, a dud is going to turn up in the batch from time to time. And this is across the board from any area of life. Just look at President Trump. Anyway, if you work in any area of manufacturing, you will see this repeatedly. It doesn't matter how many rules, guidelines, or systems you put in place. From time to time, you're just going to get a dud apple in the box, or from a statistical point of view, an outlier that really skews your results and could be down to absolutely anything. So, for example, my analogy going back to an apple picker, maybe the apple picker didn't get enough sleep that night, or maybe part of the machine that would usually pick out the dud was not working or needs cleaning or something like that. Anyway, I think this applies to trading, and sometimes there are moments when I look at my trades and I just wonder, why on earth did I take that trade no matter how many rules or criteria I have in place? I just can't ever truly eliminate these outliers from cropping up. Furthermore, I have found not to worry about it, but know it's going to happen. And this is the best way for me going forward. And at the same time, these can actually make the best trades and even cause you to question your whole approach. I think this is the key to his question here when he says this. I have found out not to worry about it, that it's going to happen. And the best way going forward for me is that these can actually be the best trades and cause me to question my whole approach. Sorry for the long-winded essay. I just thought it was something that you, yourself, and Darren might find interesting, as we are often taught to cherry-pick our trades, and I know that it is something that I struggle with for myself from time to time, for one reason or another, and I'm sure that other traders out there must be also. Anyway, thanks for taking the time to read this. I love the podcast, and I hope to hear from you. All the best. So, Chris. So that's Chris's question, and what are some of your initial reactions?
Well, I think he's coming at this from two angles. He's talking about his execution, I think, because when he says a dud trade, does he mean a trade that was fitted all the rules, it looked perfect? I'm imagining that he's allowing some sort of discretion to come into his selection of trades, and I'm presuming that what he's saying is, he'll have a perfect setup that doesn't work out. I think that is a case of not accepting the uncertainty of the situation. You're going to get variance in your results. Something that fits all the rules and looks like a perfect setup is still not guaranteed to work out the way you expect. And I think from that point of view, that's just a case of accepting that to be a fact. But he does touch on the point of execution as well. And, I think that is something that you're never going to be perfect at, but you can certainly train yourself to make less mistakes.
Yeah, I think that's right. I think there's a few things these kind of folded up here in the question. For me, this idea of, he says, I have found not to worry about these dud trades, that they're going to happen, and the best way forward for me is that sometimes these are going to be the best trades and cause you to question your whole approach. To me, that's the danger, because I agree that you need to look at this from a long-term point of view. In fact, I would say if you're looking at trades and you're trying to figure out how things are going, I would break it up into chunks of 30 or 50 trades when you're examining your or win rate or whatever your average winner, if there's something that you're worried about, I would definitely not look at just one trade. Do you agree with that?
Yeah, yes, definitely. And I think the style of your trading, the mechanics of your system have to be taken into account as well. If you're trading a very low win rate system with a big risk to reward, then if you're looking at a small number of trades, it's not really going to give you an accurate idea of what's going on, whether it's good or bad. Something with a higher win rate, then I suppose a smaller batch can give you a better idea.
Yep. It's interesting that you say that, because that's like you sounded like one of my statistics professors, Darren.
Good.
Because you're right. You're right, though. I mean, it's true. When you're looking at proportions, this is a really critical point, I think, for traders, because you nailed it. When you're looking at percentages, proportions, for example, like a win rate, if your win rate is down at the extreme end, if you have a 98% win rate or like a 5% win rate, somewhere on the extreme edge of the scale, then you need more sample to actually nail down what is the exact. If you're trying to put a confidence interval and say I'm 9% confident that my win rate is in this area, you need more data. Whereas if you have a 50% win rate, you actually need fewer data. Isn't that weird? I mean, it makes sense. You think about it, because you're kind of like you're almost off the scale, aren't you, when you have a 98% win rate or a 7% win rate? So you need more data. But this is something that people often don't think about, is that, to use your example, if you have a 35% win rate, then you're going to have a lot of losers. You're going to have occasional big winners, and so you just can't look at 5, 6, 7 trades and say, oh, this thing totally doesn't work anymore.
Yeah, and you have to look at the market condition as well. You can test 1 year, and it might just be that there was 3 or 4 instances in that year that the market conditions were perfect for your style of trading. And then in the current year you're trading, let's say only 2 of those periods occur. It's going to make a massive difference to your results, but it doesn't necessarily mean that your system is broken, because I think all systems are generally designed to work on certain market conditions, and they can occur for shorter or longer periods of time, and there's many factors that can change that. So it's really difficult to label individual trades as dud trades or not. All you can really do is, you've got a plan of attack. All you can really do is look how you're executing that plan. That's the only real true measure of your trading. And it might just be that this is a bad year for your system, but you've got no control over that.
Exactly. Yep. And I think that the focus for the trader should be on you, the trader. If you're a discretionary trader, actually, even if you're trading robots or expert advisors or whatever, you should really be looking at yourself. But that's kind of a little bit different, because you're also babysitting those things. But if you're you're a discretionary trader and you're making decisions like, I'm going to buy here or sell here, I'm going to put my stop here, I'm going to look at taking profit there, your focus should be on you. Your focus should be on, what are you doing? Are you are you it's sort of like a coach? Like a coach is looking at the team and saying, what's my weak link here? Who's the player that I need to replace or whatever? And that's the same thing I think that you should be doing as a trader. Most of what I look at in my journal is, am I actually executing my trade correctly? So that means entry, that means exit. These are the sorts of things that I think are going to help you as a trader. And that's why it gives me pause when I read this part of Chris's question, because it's a great question. I think a lot of traders run into this. But when he says that sometimes these can be the best trades and cause you to question your whole approach, I don't necessarily agree with that. If you have a really weird dud trade, I'm concerned that questioning your approach can lead to changing your approach, adding a filter, adding a rule, trying to to curve fit, basically. That's my main concern with this.
Yeah. That's definitely that curve fitting thing kicking in there, isn't it? I'm presuming by what he's written that he's a discretionary trader, and he is, I'm making some assumptions here, but what I presume is that he's looking at the chart, he's looking for a particular chart condition to set up, and if he gets that right, then he has a winning trade. And I'm imagining that sometimes he takes a trade that doesn't fit any of those rules and it turns out to be a really big winner. And that's probably throwing him, but there's a lot of tests out there. You can trade with random entries and still make money. So the fact that your approach is to wait for a specific setup, let's say you're waiting for momentum and you're going to try and get in on a retrace on that momentum, that's a valid approach, but it doesn't mean that you can't just slap an entry at any time and use the right money management and make money, and that trading is always going to tear you in that way. You're always going to see opportunities that were there that are the polar opposite of what you do. And if you're losing at the time, you're going to be drawn to, am I doing the right thing here? Maybe I should just enter randomly. Maybe I'll do better that way. You have to remember that it's not a case of finding the best trading strategy. It's just finding one that's okay and that's consistent and that you can execute consistently over time. And you just have to accept that sometimes you would have been better off not trading that way.
Yeah. Do you think that one of the big rabbit holes for traders is trying to find a quote better system or to improve a system?
I think so. I think it's more a case of our expectations are too high. We want too much success. We want to win more than we have to. We want to make money every day. And generally the things we want, let's say you want a high win rate and you want massive returns. Generally high win rate systems mean that you're going to have a shorter risk to reward. And shorter risk to reward generally means smaller returns. We tend to we want our cake and we want to be able to eat it too. And that's just not possible. You've got to decide which camp you're going to sit in. You want to get big returns, then you're going to have to let your trades run. If you're going to let your trades run, then probabilities are that you're going to have a lot more losers and longer drawdowns. So you can't have it all.
Yep. I think we talk a lot about the cognitive biases and why trading can be so difficult. I think this is one of the big ones. I think I can see how it would happen. Just imagine you come into trading because you read a book about some trader or you watched some documentary or something, or you heard about some guy, that's making money. I can just see where you would assume the reason why that, because I did. I remember. The assumption would be that, well, somehow this guy or this trader or this, this fund or whatever had cracked the code. So it's really all about learning the code, unraveling what's going on here in the market, which sort of implies that you're right more than you're wrong. And that trying to win is the answer. And I think that's really at the heart of a lot of what goes wrong for traders, is because, like you say, these high reward to risk ratio systems, it's like the best traders are getting paid for learning how to lose.
Yeah, 100%. And it's tough.
Yeah.
It is really tough.
Yeah, exactly.
When I've seen people do stop loss and take profit optimization, okay, generally the really big returns are down near the sort of win rate of, say, the 30% mark. Once you get over a certain amount risk to reward in optimization, say over 10 to 1, the win rate doesn't really drop anymore. Okay, it stays. It kind of gets to the point where if you stuck in random trades and hold them long enough, then you're going to get a certain amount of winners just by the nature of how price moves up and down. You're going to catch some tops and bottoms just purely out of luck. In all the testing I've seen, that's kind of where it lies. But convincing yourself that you're going to lose that much to make money is just completely counterintuitive. And that's why most people don't go there. Most people don't even attempt to go there.
It's psychologically painful, isn't it? It's like going to the dentist or whatever, and it's going to hurt. And for a lot of people, it's just not worth it. They don't go. they just don't go. It's not worth it.
Yeah. But I think half the problem is that most people aren't doing it. And the masses are telling you that I prefer to take profit early and, I prefer a higher win rate and a smaller risk to reward. And I'm doing really well doing that. So it's quite hard to confront that fear and kind of do something different.
Yeah.
I find once you start doing it, the buzz you get off the big winners and watching how the difference that makes in your profit, after a while, those consistent losers, they hurt less and less.
Yeah.
Because you're expecting it. You're pretty much every trade you put on, you're expecting it to stop out. And then when you do get one go, run, you're like, oh, that's quite a nice change, isn't it? Wasn't expecting that at all,
Yeah.
And it's a difficult mindset to take on. And I think a lot of people try it, but they just give up too soon.
Yep. Probably the best way I've seen to sort of get this across is to play a game. If you have like 10 pieces of paper and you mix them up in a bowl or something like that, and you would and what you write, so you've got 10, you got one of them that's 20R, so that's 20 return on your risk, and then you have like one 5R, so that's 5 return on your risk. Okay, so that leaves 8, and then the remaining 8, you've got 5 that are 1R losers, so negative 1R, and then 3 that are negative 2R, right? So you kind of get slipped or whatever and stopped out. So, and then what you do is you just keep drawing those up and just keep taking those trades over and over again and see what happens. And it's like you say, you're just waiting on that big winner, and it's kind of addictive. I mean, we like in psychology, we know the most addictive form of reinforcement, which is just when you reinforcement through behaviorism, this idea that you reward someone and then the behavior is more likely to be duplicated in the future. It's one of the few laws in psychology. If something is rewarded, it's more likely to happen in the future. Well, the most addictive one, the schedule of reinforcement, as it's called, that's most addictive is the same one that you're talking about, the same one that you get when you go and play the slot machines. You go to the pokey machines and you play them. You never know what's going to happen. If you're going to get a big payout or if you're going to just lose a little bit of money, that's the most addictive schedule of reinforcement. And that's basically trading. I mean, that's all trading is. So when you're at that point where you're playing the long game, and I think this is the other thing that Chris brings up in his email that's so critical. He talks about this idea of manufacturing, and you'll see that no matter how many guidelines or rules or systems you put in place, you're going to get a dud apple that comes down the line, so to speak, time and time again. It's going to happen. What I found, and I learned this from Ralph Vince. Ralph Vince is the guy who wrote the New Money Management, and he was the math guy he's completely self-taught, which is fascinating. But he helped Larry Williams win the trading competition years and years and years ago in whatever it was, 1988 or 83 or whenever it was. And basically Larry Williams said to Ralph Vince, for those of you who don't know, Ralph Vince, he said, look, you tell me how much to place on how much risk to place in each trade, and I'll do the rest. And that's how he was able to make 10,000% that year, was by using the optimal F strategy that a lot of people are familiar with. Well, Ralph Vince was talking about, this question, how do you know when you've got just a regular dud that's come down the assembly line versus when your system is actually breaking, when either the market's changed or my system doesn't work anymore, which are the two common complaints that traders have. They'll say, well, the market's changed or my system doesn't work anymore. Now, it could be that, but I think most of the time it's just a drawdown. So Ralph Vince's, the way he's tackled this problem, and the way that I've been doing this, is the same way, which is that they look at manufacturing, which is when you get something that comes down the line, what you need to do is compare it to the gold standard and say, is this the right win rate? Is it the right average winner, average loser? Is this fitting? The key shift I made was not to look at it trade by trade. What you do is you look at chunks of trades. So what that means for, like, if you're trading, let's say you trade and you take maybe an average of 12 trades a month. So you're not really a high frequency trader. Then you might then look at your trades and examine them every 30 trades. Okay? But if you're a trader and you trade, let's say you take 20 trades a week or more, you might look at chunks of 50 trades and compare them to the gold standard. Gold standard, of course, being your average winner, average loser, and your win rate. Those are the key metrics that you want to look at. So I think Chris here has really pulled up something that's critical, which is this idea of using the assembly line point of view. This, I believe, is one of the best ways for you to identify whether or not your system is breaking. The key, again, is to look at chunks of trades instead of units of trades. That's where we go wrong, is when we look at one individual trade or two individual trades and we go, oh, everything's broken. So I think that's one of the biggest mistakes that traders often make. At least I've known myself to make it.
Yeah. Is it because we start with the wrong expectations, basically?
Probably. I mean, I do think that when you come into trading new, there's this assumption that someone who does well at trading does it because they've cracked the code or they've figured out some secret thing, That's kind of the assumption. I don't know, maybe I'm wrong, but that's how I remember the amount of time and effort that I put into trying to learn GAN. Like, it's ridiculous. I look at it now and I laugh. This is ridiculous. And I was like turning autistic or something. Like, I just had this calculator that I carried around and I was drooling, and I was just like, all I did was just look at this calculator and I was trying to figure out the GAN code, and it was maddening. I've been places where I wasn't even paying attention to my environment because I was so keyed in on trying to crack the GAN code. And then I'd look up and everyone would be gone. It was like, it'd be like, I remember one time I was at the mall and I was at the food court in the mall and I had my calculator and I had some food at lunchtime and I was probably trying to figure out this GAN thing. And then I look up and there's literally nobody around and the mall is like closing, you know what I mean? Like, security guard's going to send me out. And it was the weirdest thing and I was like, whoa, I'm really into this. Like, I was starting to question myself whether or not what I was doing, like, I was still convinced that I was just around the corner from figuring it out, but I'm so glad that I didn't go that way in terms of my trading, because I think that puts a lot of pressure on yourself to assume that you've cracked the code, that you have everything right. Like, I don't know what those people say when they have losing trades. Like, what do they say? Like, the market's wrong or something? Like, I don't know. Like, I don't know how you deal with that. So, yeah, I think the more fruitful path is to focus on your execution and simply understand that you get paid as a trader for absorbing those losses. And that I think is probably the lesson for me here, is that absorbing the losses is the key to becoming a high reward risk trader. I don't know that Chris is doing that, but I do think that that's one of the key things here that comes out in his email is, learning how to accept those losers. And then if you want to look at, how things are unfolding, I think using that assembly line approach, using that quality control approach makes a lot of sense. But I think the key there, of course, is to chunk it out and look at chunks of trades instead of individual trades.
Yeah, I'm with you, Walter, and, I think the only dud trade that really exists are failures in execution. And, your system is naturally going to give you dud trades. That's part of it. But as long as it kind of fits in with, your approach and what realistic expectations are for that approach, if you have a 50% win rate, you can still get 10 losers on the trot. And, it's about having that, knowledge about realistic expectations for the way you're trading.
Yep, exactly. Thanks so much for the question, Chris. And we will see you next time, Darren.
Okay, thanks, Walter.